Hello everyone, this is Ted Bauman here with your Friday Bauman Daily video. I have a lot of information I want to share with you today, so I'm going to move fairly quickly. Before I do, just want to say RIP Eddie van Halen, as we would say in South Africa, but Eddie Van Halen, as the world knows him, absolutely stunning guitar player, somebody who really essentially reinvented the instrument in the early 1970s. He will be missed. Let's start with a big question. Why have markets rebounded? And no, it's not because I said they wouldn't. I still believe that the markets are not a good place to buy right now simply because you don't buy high and sell low, and I think we're going to go lower. I think that the first reason is rising long-term yields. There's a bit more optimism in the markets. People are looking at the yields. Here's a chart that shows them. They're topping out the 10-year Treasury just over 0.775. So essentially, I think there's a lot of optimism in the market. People are starting to say, hey, there might be life beyond stocks. And that's one possibility. The second one is misplaced optimism about stimulus. It continues to mystify me why people still think there's going to be stimulus from this particular configuration of politics in Washington. It's not going to happen now. It's not going to happen after the election, at least not in the form people have been talking about. And here I just want to show a little Twitter poll that I conducted a couple of days ago, basically asking people. It says, news reports say Trump decided to call off stimulus talks because his supply side advisors told him that fiscal stimulus causes recessions, but tax cuts cause growth. You get that fiscal stimulus causes recessions, but tax cuts cause growth. Now, 40% of people believe that tax cuts are going to cause or stimulate the economy under the current circumstances. Folks, have you not read any actual history? Right now, what we have is a dramatic insufficiency of consumer demand. We have a supply side shock, not in the form of lack of capital, but in the form of industries that are simply not able to function, like the airlines, hotels, entertainment, etc. Under those conditions, what are tax cuts going to do for you? The whole theory behind tax cuts is that it drives investment. It's a theory that's been disproven again and again and again. You can't find any historical support for it, except in very specific, very short-term situations in specific sectors. It's not about tax cuts, folks. It's about getting money into people's hands to buy. If you really want to be a smart investor, you have to give up your illusions, and that is a big one. Now, here's the real deal. This is why I think we are seeing the markets in the uptick, and I know it's going to make a lot of people upset. Again, this is not about politics. This is just about what it is, as the president says, and that is the fact that there is less concern about the election result being close enough to be contestable. Here's a chart from Real Clear Politics that shows recent developments in the polls right now. The betting average shows that Joseph Biden has a 65, nearly a 65% chance, or is favored by 65% of the polls and the bettors to win. Now, my thesis is that that is bullish for the stock market. Don't take my word for it. Here is a quote from Goldman Sachs. All else equal, such a blue wave would likely prompt us to upgrade our forecasts. The reason is that it would sharply raise the probability of a fiscal stimulus package of at least $2 trillion shortly after the presidential inauguration on January 20th, followed by longer-term spending increases on infrastructure, climate, healthcare, and education that would at least match the likely long-term tax increases on corporations and upper-income earners. So don't take my word for it, folks. Wall Street knows which side our bread is buttered, and that is the side of fiscal stimulus. The bottom line remains that if you take a macroeconomic view, the economy is in a demand-sufficient condition. There is no incentive for investment and business investment to make up the gap. So that gap has to be made up by government spending. That is pretty much the evidence of the entire 20th century. Now, you can call me a Keynesian, you can call me whatever you like, but the bottom line is this is what is supported by the facts. And that's why people who are paid big money to manage stock portfolios and make investments and trade are saying exactly what I'm saying. Now, let's look briefly at why I think still that's not a great indicator for U.S. markets as a whole and where the alternative opportunities lies. First chart I want to show is the Buffett indicator. If you've ever heard of that before, it is essentially the total market capitalization of all stocks in the United States as a proportion of GDP. Now, it's gone up and down. It was really high. It was over 150% around the dot-com boom bust. Now it is at 200%. Now the trend line here shows that it's fair enough to say that the Buffett indicator rises over time as risk perceptions of risk decrease as the economy stabilizes, particularly after the end of the Cold War. I think there was a good reason for stock premiums to increase, or rather the risk premium to decrease, allowing PE ratios to go higher. But the trend line suggests that we shouldn't really be anywhere above 120%, and yet we're at 200. Next chart shows comparative CAPE ratios for a number of different countries. The CAPE ratios are an average of longer-term price-earnings ratios. It's not just the immediate one. You can see the blue one, the USA, is above everybody else. It's over 30. The next one down, it's a little bit hard to see, but it's India. Below that is Europe, and at the bottom is Korea. Now, why do I flash up comparative PE ratios from different countries? Well, the thesis is simple, folks. Those stock markets are very much undervalued relative to the United States, and I believe there's going to be a rotation of money into those stocks once it becomes clear that the combination of the fact that we're at a market top, historically unprecedented market top, the fact that there are big political headwinds facing the technology sector, the fact that we are uncertain about what will actually happen after November, and the likelihood is that there may be some more tussling to go before it all. Bottom line is that I think money is going to start looking for returns elsewhere, and that elsewhere is likely to be in foreign markets. Now, here's a chart from GMO, which is a big asset manager, and it shows that their 7-year projection shows U.S. large cap stocks with an annualized loss of 1.5 over the next 7 years. Small cap stocks up a little bit. International large caps up by about 2%. International small caps a little bit less than 4%. Emerging market stocks 4.9%. Emerging value stocks, in other words, emerging companies or companies in emerging markets. Think Brazil, think Vietnam, think India, that are undervalued relative to their actual earnings. They are likely to achieve growth rates of around 12% per annum. And on the right-hand side, you can see the returns in the bond markets. That's the expectation that we will continue to see loose money everywhere. We will see good returns in emerging debt because, of course, those countries will want to borrow with interest rates so low. Now, this wouldn't be the first time that international markets have outperformed. I showed in an article on Tuesday this graph. It shows that during the 1970s, during the middle of the 80s, and again during the middle of the 2000s, the international equities outperformed the US by quite a significant amount. Now, since then, I think the big driver obviously has been the fact that the Fed controls the dollar and has been able to continue to stimulate with liquidity and with credit debt or credit market backstopping, has been able to stimulate the US stock market, and that has kept that figure above for about 9.3 years. Now, as I've argued in the past, the Fed is running out of juice there. It's not going to be able to keep doing this. They're at their lower bound. Already there are signs that many of the Fed governors don't agree with keeping interest rates low. So we're likely to see, again, headwinds against U.S. stocks. If you take it that you don't want to fight the Fed, well, the Fed's not fighting you at this point. It's not trying to add money to the markets because it can't. It's at the lower bound. So this is what this translates into. Let's look at a chart that shows the Buffett indicator for countries other than the United States. Now, this is a selection of countries that I looked at, but as you can see, the projected 10-year annualized return for the U.S. stock market based on the historical relationship between stock valuations and GDP, between the historical track record of growth and dividends and so on, is that the United States will probably see a decline of around nearly 3% annualized returns over the next 10 years. But look at some of the other countries. Just to our north, Canada, likely to see 5.7 annualized growth, France 5.9, Brazil 6.9, India nearly 10%, Italy strangely enough, 10%. Go all the way to the left and you see Singapore, Indonesia, Spain, and Mexico all in the lower teens. Now, what does this mean in practice? Well, it simply means that these are markets where you can get the same value in terms of the actual earnings of the companies, the dividends that you'll get at a much lower price than you can get them in the United States. And as the stock market in the United States begins to realize that we are at a top, kind of like Wile E. Coyote going out over the gap and then falling, they will start to look for investments elsewhere. Now, it's unlikely that those foreign levels will be achieved in practice simply because that is an exercise that's based on pure statistics. It leaves out the politics, etc. But definitely there are other people looking at those statistics and thinking, I really need to put some of my money in those markets, folks. This is where the money is going to be made in the next 10 years. And as I said, it's happened before. So let's look at two specific opportunities that you could potentially exploit. One is an ETF called GMF. My colleague Clint Lee recommended this in his article on Wednesday. And essentially, it is an ETF that tracks emerging Asia Pacific national markets. And as you can see, it's in the last 6 months, it has begun to pull away from the S&P 500. Even before the beginning of the market correction or dip in September, it was pulling away, and now it is starting to pick up momentum again. Now, that's simply a reflection, I think, that this correction or this rotation is already starting to happen. People are looking to foreign markets to invest. Now, here's another picture that I think is quite striking. This is a chart that shows EMQQ. This is an emerging markets internet and e-commerce ETF, and it includes a number of heavy hitters, including some of the Chinese internet giants. But look at the performance over a 5-year period. It has completely trashed the U.S. Stock market this year. It's up over 140%, or rather 140% over 5 years, but it's up very significantly above the U.S. market, about doubling it really since the beginning of this year, after having tracked along with the market for much of the last 2 years. Now, that is a remarkable turn of events, and it's one that I think is going to continue. It's hard to say whether that particular ETF will continue to grow as quickly as it has. But of course, the thing to do with ETFs is to go and look at their underlying holdings and then decide which stocks you want to buy. You can buy the ETF too. You're likely to get the best results by doing that extra level of analysis. So there you have it, folks. I think it's important to understand that markets move for reasons that are related to current events, but also to where things are likely to go in the future. People always say markets are forward-looking. Right now, the vision for the future is that the big money is going to be made offshore. And I believe that is what you should be thinking about doing when you decide to make that leap. The Bauman letter includes a couple of outstanding foreign companies. We've already made one pick that is up nearly 40% in less than a month. We have a couple that we're about to announce soon that are also offshore picks, and all of them trade as ADRs, which are American Depository Receipts. They are companies you can buy and sell and trade on the U.S. stock exchange just like you would any other. You don't have to start a foreign brokerage. So there you have it, folks. My prediction is go offshore, young man, young lady. That's where the money's going to be made. You might even end up visiting Priska one of these days. Take care. Bye-bye.